Ever notice how some people seem to get richer even when the economy tanks? While most investors panic sell during market crashes, there's a small group who consistently turn market chaos into opportunity. In 2008, Warren Buffett invested $5 billion in Goldman Sachs during the financial crisis. By 2013, that investment had more than doubled. Meanwhile, ordinary investors lost their life savings selling at the bottom. Today, we're pulling back the curtain on the decision-making playbook that separates wealth builders from wealth losers when markets crash. These aren't just strategies for the ultra-wealthy. They're mindset shifts anyone can apply to protect and grow their money during economic uncertainty. Hey everyone, welcome back to the channel. If you're new here, I break down complex wealth-building strategies into actionable steps for everyday investors. If you find this type of content valuable, make sure to hit that like button and subscribe right now so you don't miss any future wealth-building insights. Today's topic is something that fascinates me. How do wealthy people make decisions differently when markets crash? And more importantly, how can you apply these same principles to your own financial life, even if you're just starting out? We're going to cover the 5 key decision-making frameworks that wealthy people use during market downturns, plus the psychological traps most investors fall into that keep them from building lasting wealth. Before we dive into specific strategies, we need to understand what happens psychologically during market crashes. When markets plummet, our brains literally enter a different operating mode. The amygdala, our fear center, takes over from the prefrontal cortex, which handles rational decision-making. This is why most people make terrible financial decisions during crashes. Studies show that the average investor underperforms the market by 4 to 5% annually, primarily because they buy high and sell low during emotional market swings. This behavior gap compounds over time, costing the average person hundreds of thousands in potential wealth. The wealthy approach market crashes differently. Instead of operating from fear, they activate what psychologists call strategic thinking, the ability to see opportunity where others see danger. Ray Dalio, founder of the world's largest hedge fund, calls this looking down from the mountain, gaining perspective that most investors lack when they're emotionally caught in the valley of a crash. The first wealth-building decision framework is what I call liquidity positioning. Wealthy investors maintain strategic cash reserves specifically for market crashes. This isn't the same as an emergency fund, it's opportunity capital. While most investors are fully invested when markets crash, leaving them no option but to watch their portfolios fall, the wealthy maintain 10 to 30% cash positions specifically to deploy during downturns. In 2020, when markets crashed during the early pandemic, billionaire investor Howard Marks deployed over $1.7 billion into discounted assets over just 25 days. His firm had deliberately positioned cash for such an opportunity. The key decision framework: determine your opportunity allocation, a percentage of your portfolio reserved specifically for market crashes, and commit to deploying it systematically when others are fearful. The second framework wealthy decision makers use is what I call inverse thinking. While average investors ask, how can I avoid losing money in this crash? Wealthy investors ask, which specific opportunities is this crash creating that didn't exist before? During the 2000 dot-com crash, Amazon fell from $107 to just $7 per share. Most investors fled tech entirely, but those practicing inverse thinking recognized that Amazon's business fundamentals were strengthening even as its stock price collapsed. By 2003, the stock had tripled from its lows. The key decision framework during market crashes: create a specific list of companies, assets, or sectors that are being unfairly punished despite strong fundamentals. Focus on what's being created, not just what's being destroyed. The third wealth-building decision framework is time arbitrage, deliberately extending your time horizon when others are shortening theirs. During market crashes, most investors shrink their time horizon to days or weeks. They obsessively check their portfolio values and make decisions based on short-term price movements. The wealthy do the opposite. They extend their time horizons. They ask, how will this investment perform over the next 5 to 10 years? Rather than, will this bounce back next month? This time arbitrage creates massive competitive advantage. When Seth Klarman invested heavily in distressed debt during the 2008 financial crisis, he told his investors to expect returns over a 3 to 5 year period, not immediately. This patience allowed him to buy assets at pennies on the dollar while others needed quick returns. The key decision framework. During market volatility, deliberately extend your investment time horizon and focus on 5-year potential rather than 5-month recovery. If you're finding value in these wealth-building strategies, take a second to hit that like button and subscribe to the channel. We release new content breaking down elite financial strategies every week, and I don't want you to miss our upcoming video on building multiple income streams during recessions. The fourth decision framework wealthy investors use during crashes is asymmetric risk mapping. While most investors think in terms of general market exposure, the wealthy methodically map specific risk-reward scenarios asset by asset. During market crashes, certain assets develop what investors call asymmetric upside, where the potential gain far outweighs the potential further loss. The wealthy systematically identify these opportunities. In March 2020, when cruise line stocks collapsed due to pandemic shutdowns, Carnival Cruise Lines fell from $51 to just $8 per share. The market was pricing in potential bankruptcy. Wealthy investors who applied asymmetric risk mapping saw a different picture. A company with enough liquidity to survive 12+ months of zero revenue. The downside was limited, potential bankruptcy, but the upside was 5 to 6 times if the company merely survived. By 2021, the stock had more than tripled. The key decision framework. During crashes, identify assets where further downside is limited, but recovery potential is substantial. The final wealth-building decision framework is what I call contrarian confirmation. While most investors seek comfort in consensus during market turmoil, the wealthy actively seek out contrarian indicators to confirm their buying opportunities. These include extreme pessimism in media headlines, record fund outflows from retail investors, insider buying by company executives, and price disconnects from fundamental value metrics. In December 2018, when markets dropped nearly 20%, media headlines warned of recession. Retail investors pulled over $143 billion from equity funds, yet corporate insiders were buying their own company stocks at the highest rate in a decade. The wealthy saw this contrarian confirmation and invested heavily. 3 months later, markets had recovered all their losses. The key decision framework. Create a personal contrarian checklist of indicators that signal when fear has overwhelmed reason in specific market segments. These 5 decision frameworks: liquidity positioning, inverse thinking, time arbitrage, asymmetric risk mapping, and contrarian confirmation, form the core playbook that wealthy investors use to build fortunes during market crashes. The good news? None of these require massive capital to implement. They're psychological frameworks and decision processes that anyone can apply regardless of portfolio size. Remember, market crashes don't destroy wealth, they transfer it. By adopting these decision frameworks now, you'll be positioned to be on the receiving end of that transfer during the next market crisis. If you found this valuable, don't forget to hit that subscribe button and drop a comment below with which of these 5 frameworks resonated most with you. Until next time, I'll see you on the next video.